The CME just cut silver margin requirements by 22% in a single move. That is not the story. The timing is the story, because on the exact same day that margin cut hit the wire, registered silver inventory dropped nearly 6 million ounces across 7 custodians in a single overnight session, and the physical market is under more squeeze pressure than it has been in years. That sequence deserves your full attention right now. I am going to show you exactly what the margin cut actually means structurally, why the registered drain data changes the entire read on it, what the Shanghai premium is telling you that the Western price is not, and what the gold algo pattern running at 8 a.m. Eastern for 4 straight days has to do with all of it. There is one number buried in the custodian data that most people will read past entirely. I am going to come back to it after I show you the Shanghai picture, because without that context it just looks like a vault shuffle. It is not a vault shuffle. This channel exists because there is a gap between what mainstream financial media covers and what is actually moving in the physical metals market. That gap has never been wider than it is right now. The kind of signal we just saw, 7 custodians draining simultaneously overnight, that is exactly what this channel exists to explain. Before it shows up on CNBC, if that is why you are here, drop Legacy OG in the comments. That is it. Just so I know who is paying attention. The registered drain is accelerating. That is the only backdrop that matters as you read everything else in this video. Now let me show you the margin cut in context. Going into today, the CME had raised margins on silver futures 6 consecutive times during the recent metals run. 6 increases. That playbook is not subtle. You raise the cost of holding a leveraged long position. You force undercapitalized traders to reduce size. Open interest collapses. Participation thins out, and price becomes easier to move with less paper. That is what happened. It worked. And now, with registered silver at its most critical level in years and physical demand running 3 times its year-over-year pace out of Shanghai, the exchange makes it cheaper to be in this market again. 2 interpretations sit on the table. 1, they need paper traders back because volume and open interest have fallen to the point where the market is losing them. 2, reducing margin makes it cheaper to hold short positions into a squeeze environment. Both are worth sitting with. The positioning data that follows this cut is where the answer will show up. Watch the next 2 weeks of commitment of traders' reports. Here is the data underneath that. Managed money silver longs are at a 2-decade low. Silver ran from roughly $30 to over $120 in this cycle. Through that entire move, money managers cut their long exposure by approximately 70%. 70%. Physical silver has been in structural deficit. For 5 consecutive years, paper positioning is as bearish as it has been in 20 years, while the physical market is as tight as it has been in a decade. That is not a contradiction. That is a setup that has been building for years. What it is not is a timing signal. Anyone telling you this resolves next week is selling something. Now the drain, the Wednesday COMEX report has now dropped. Nearly 6 million ounces of registered silver adjusted out overnight out of Asahi, Brinks, Cient, Delaware, SHBC, Loomis, and StoneX simultaneously. 7 custodians, 1 night. Registered silver now sits at 81,235,000 ounces, down from 87 million the same morning. That is the number I told you to hold. Most people hear custodian adjustment and move on. Here is what that actually means in plain terms. Registered silver is the only silver the exchange can use to make delivery against open futures contracts. When it drains, the pool of deliverable metal against paper obligations shrinks. There are now roughly 230 million ounces of open interest trading against that 81 million ounce registered pool. That ratio should be on the front page of every financial publication. If you are new here and that ratio sounds technical, here is the plain version. There are more people in line for a chair than there are chairs, by a wide margin, and the number of chairs just got smaller overnight. That is the context the margin cut lives inside of. Keep that in mind as we go further. Now let me connect this to Shanghai, because the paper to physical dislocation is not theoretical anymore. It is showing up in price. Shanghai silver spot is trading at $93, futures at $95. Western spot is at $82. That is an $11 premium sitting between the Eastern physical market and the Western paper price. That premium does not exist because of logistics. It exists because the physical market in the East is pricing scarcity that the Western paper market is not yet pricing, and silver withdrawal data is running nearly 3 times higher year over year right now. 3 times is not a seasonal pattern. 3 times is a structural shift in physical demand. The people who spent years being called conspiracy theorists for arguing that paper silver traded disconnected from physical reality, the data is making their argument for them right now. Here is what nobody is talking about. Managed money is net bearish on paper. Physical demand is at multi-year highs. An $11 premium sits between the two markets, and the CME just made it cheaper to enter this paper market the day the registered vault hit a critical low. You do not have to decide what that means today. You do have to watch what happens next. Now the gold algo pattern, because it connects directly to the same institutional manipulation framework, for 4 consecutive trading days this week, gold sold off sharply at exactly 8 a.m. Eastern, Monday down nearly 3%, Tuesday down over 4%, all the way back to $5,000, Wednesday down nearly 2%, Thursday down another 2%, for $1 trillion in paper gold value erased in 4 sessions, all triggered at the identical time, all with the same mechanical signature. Natural selling does not trigger at the identical minute for consecutive days. That is an algorithm. The same timing structure appeared in Bitcoin for months before scrutiny forced it to stop. Some market analysts are pointing to Jane Street in connection with this pattern. That is unconfirmed. What is not unconfirmed is the pattern itself. Verify the charts. The question the ones paying attention are asking is where the CFTC is. And while that pattern has been running, global gold ETFs took in $5.3 billion in net inflows in February alone. That was the 9th consecutive month of inflows and the strongest start to a year on record. Total global gold ETF assets under management climbed to a record $71 billion. The institutional money is not leaving gold. The paper price is being moved at 8 a.m. Those two facts exist in the same market simultaneously. Now let me show you what could delay this thesis from playing out, because honesty matters more than cheerleading. The dollar is consolidating ahead of tomorrow's NFP release. If the dollar gets follow-through above the January 15th resistance level and closes there, paper metals face additional downside pressure in the near term. Open interest is at decade-low levels. Thin participation means price can move sharply in either direction on limited volume. The CME margin cut could be used to load short exposure cheaper into a major data release. None of that changes the structural picture. All of it is real short-term risk. Counter pressure. The physical drain is not a paper event. 7 custodians did not coordinate an adjustment to influence sentiment. The C withdrawal pace cannot be manipulated by an algo at 8 a.m. The $11 Shanghai premium is not a rumor. An algorithm can reprice paper in a thin market. It cannot create deliverable silver. That does not exist. Now verify independently. Check the COMEX registered reports directly. Verify the CME margin announcement. Pull the C withdrawal data year over year. The ones who do that homework understand what is building here without needing anyone to explain it after the fact. For physical holders, the fundamentals have not changed. The structural case has gotten stronger today, not weaker. Hold position. This is not financial advice. Use your own brain. For futures traders, this is not a clear environment. NFP tomorrow. Dollar at a decision point. Thin open interest. If you cannot size correctly for a move in either direction, the sidelines is not weakness right now. It is the only edge available. For ETF investors, the institutional inflow data is telling you something the paper price action is not. Understand what you own and why you own it. For everyone watching from the sidelines, you now have more structural context than 90% of people trading this market. The question is what you do with it. Scenario 1, bullish. NFP misses. Dollar fails to hold above the January 15th level. Paper pressure eases. Registered drain continues accelerating. Shanghai premium widens further, and the paper to physical gap starts to close from below. Silver targets above $100 come back into frame. Probability, 35%. Scenario 2, neutral. NFP reads in line. Dollar consolidates without a decisive break either direction. Registered drain continues but paper positioning stays suppressed. Silver chops between $78 and $88 for the next several weeks while the structural case builds further. Probability, 40%. Scenario 3, bearish. NFP beats. Dollar breaks out and closes above resistance. Paper metals face renewed algorithmic selling pressure. Silver tests the $75 level, and weak hands get shaken out again before the physical reality reasserts. Probability, 25%. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain, do your own research. Always, physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.